Hey, and welcome back on the Easy Finance channel. Today, we're diving into one of the most fundamental concepts in accounting and finance assets. I will explain everything very simple for you. What are assets? What types of assets are there? And also how assets are valued. In the end, I will give you a short real life example to understand the content better. So, let's get started. So, what is an asset? First off, we start with a simple definition at the beginning. Assets are everything a company owns that has value and can generate future benefits. As you can see here, the building or the inventory, but also some things people don't recognize directly as assets. For example, software or patents. So, on this slide, you can see one of the most important formulas in finance and accounting. This formula will come over and over again, so memorize it, it's really important. It says assets equal liabilities plus equity. It is known as the accounting equation. If we look at the balance sheet, we have two sides. We have the left side, which are the assets, and we have the right side, which are the liabilities and the equity. The left side shows what the company owns, and the right side shows how it's financed. So, liabilities with money of other people, or equity with our own money. For assets, we distinguish between three types of assets. First, we have the current and the non current assets. Second, the operating and the non operating assets. And then last, we have the tangible and the intangible assets. So, here we have the current and the non current assets. Current assets can be converted into cash within 1 year. That's why the name is current, because we can really fast convert them into cash. As an example, we have for sure cash, but also accounts receivable or inventory, because normally it doesn't take so long to convert this into cash. The non current assets can't be converted into cash within 1 year. Examples are property, plant, and equipment, or also called PPE, long term investments, or intangible assets like patents or goodwill. Also, buildings, if you think of it, you want to sell the building and you want to have the cash guaranteed. You can't guarantee the cash within 1 year, so the building would also count as a non current asset. So, the second type of assets are tangible assets and intangible assets. It is pretty simple. Tangible assets are physical assets you can touch. For example, the building or the inventory you can see. Intangible assets are non physically, so you can't touch, like the software or a patent. It is important to say that an asset can't only be classified as one type of asset. You can have a current asset that is at the same time a tangible asset. So, also, there's a crossover possible of the types of assets. So, now we move on to the operating assets and the non operating assets. Operating assets are the ones a company needs for its core business. For example, inventory, property, plant, and equipment, or accounts receivable. Non operating assets are things that don't directly support daily operations, like excess cash, investment, or land that's not being used. Why does it matter? Because operating assets show how much is invested in running the business, while non operating assets can be seen as extras or future reserves. In the next step, I'm going to explain to you how assets are valued. Assets are usually recorded at historical cost, the price paid to acquire them. But over time, some assets lose value, like machines or car. That's where the depreciation comes in. Other assets like software or patents are amortized. There's also something called fair value accounting, where certain financial assets like stocks or bonds are updated to reflect current market prices. But we will go deeper into these valuation methods in later videos. Assets are not just listed on the balance sheet, they are also used in important financial ratios. Some key ratios include return on asset, also called ROR. This shows how profitable a company is in relative to its total assets. The formula is net income divided by total assets. Another ratio is the asset turnover ratio. This tells us how efficiently a company uses its assets to generate revenue. And then last, we also have the current ratio. This compares current assets to current liabilities, showing how well the company can pay its short term debts. Let's take a closer look at some real world examples to understand the content better. I've listed here four different assets. Now it's your turn to stop the video and solve if the assets are current or non current, operating or non operating, and tangible or intangible. First, the cash register. It's a tangible asset because it's a physical item, and it's an operating asset since it's used every day in the business. Because we expect to use it for more than 1 year, it is a non current asset. Next is espresso machine. Just like the cash register, it's tangible and part of the coffee shop's daily operation. Since it has a long lifespan, we classify it as an operating, non current asset. Now, the brand logo. You can't touch it, but it's valuable. This makes it an intangible asset. It's part of the shop's identity and therefore an operating asset. A logo is also a non current asset because its value extends over many years. Finally, unused property. This is still a tangible asset, but it's non operating because it's not used in daily business. And because property is held long term, it's a non current asset. These examples highlight how assets can be tangible or intangible, operating or non operating, and current or non current. If you found this video helpful, give it a thumbs up and subscribe to Easy Finance for more clear and practical explanations of key financial concepts. Want to learn more about liabilities, equity, or valuation models? Check out the links in the description and drop your question in the comments. Thanks for watching and see you in the next video. Bye bye.